All right, welcome everybody. We're going to begin now. All right, so today we're going to look at the exchange rate policy in Singapore. So first, let me pull up my slides. All right, so exchange rate policy in Singapore, right, is basically a policy aimed at having two main objectives. The first key objective of exchange rate policy is to maintain what we call a stable exchange rate. What does that mean? That means that the goal is not to get the Sing dollar to fluctuate too much against foreign currencies, in particular the currencies of our major trading partners. So we don't want too much fluctuations. The reason is because we want to minimize what is called exchange rate risk. Exchange rate risk then refers to the risk of exchange rate changing, right, for firms that are involved in both imports and exports in terms of the costs and revenues in the local currencies. So at the point of transaction or the point of a contract, right, and versus the point of payment, right, if the exchange rate changes, then this can affect the company's revenue as well as costs. So it's because Singapore is a country that trades a lot with other countries, right? So the export and import the risk, right, of exchange rate fluctuations become very significant. All right, so the second goal of the exchange rate policy in Singapore is to deal with what we call price stability. So basically to achieve a low rate of inflation. So we're using Sing dollar appreciation as a way to manage inflation rate. So these are the two key goals. All right. So with that, let's move on to the next thing. So how does Singapore actually maintain the exchange rate stability, right? It's through what is known as the NEER, or nominal effective exchange rate. So what MAS does, right, instead of managing the bilateral rate between Sing dollar and let's say the US dollar or the Sing dollar with the Chinese yuan or Sing dollar with the Malaysian ringgit, right, we measure what is this thing called the nominal effective rate, nominal effective exchange rate, which is the trade-weighted average basket of the currency of Sing dollar against that of our major trading partners, in order to get some average index value. Now, once we have this trade-weighted basket, right, then what the MAS do, right, is to then set what is known as the upper limit and lower limit. So we will set a band of allowable exchange rate that the NER is allowed to fluctuate in. So, for example, you can see from this picture, right, that if the NER, which is a trade-weighted basket of average of our currencies, were to fluctuate within the band of allowable NER rates, right, then MAS will not intervene. But if, however, it goes up to, let's say, the EMAX, for instance, then any further increase in the average exchange rate in Sing dollar and this basket of currencies, then the MAS will intervene into the forex market through what is called open market operations to sell Sing dollar, to buy any number of these currencies in order to bring the NER in line with the target range. Right, so this is called the band of allowable exchange rate. So what happens, right, is to intervene in the forex market to keep it in the band. Now, the idea here, right, is to keep the band itself not public. And so the NER itself is not publicly announced in terms of which are the currencies that we use to calculate. The weights that we use to calculate each currency into the average is also not made public. And the band is also not made public. The primary purpose of all this opacity, right, is to try to make it difficult for speculators to be able to reverse engineer from the data when and how MAS will intervene. There's only one goal to this. The goal to this, right, is to make it such that it's difficult to profit speculating on the Sing dollar or speculating against the Sing dollar. So the goal here is discourage speculative activities. And if they are successful at discouraging speculators from speculating on the Sing dollar, then this adds to the stability of the Sing dollar. So this forms the two key tenets of Singapore's monetary policy: to have a basket of currencies that we manage the average exchange rate, and to set an undisclosed band of allowable fluctuations within that rate. Right, so then once we have this basket and band, right, then MAS will try to adjust the exchange rate either within that band or sometimes move that band up or down in line with economic circumstances, with the purpose of achieving this thing called price stability. Right, so the goal here is to achieve low and stable rate of inflation. Now, how does the MAS actually go achieve this low rate of inflation? The way to achieve this low inflation, right, is actually primarily through what we call appreciation of the Singapore dollars. So let's go through the theoretical mechanism within which this works. So, for example, if we were to appreciate the Sing dollar, let's assume that we have inflation. An appreciation of the Sing dollar would cause the price of Singapore's exports, what we call PX, in terms of foreign currency, to be higher. Meaning that if now one Sing dollar is now worth more foreign currency, then every unit of Singapore's goods, when measured in foreign currency, becomes more expensive than before. So based on law of demand, right, foreigners will buy less of our goods, so quantity of exports will decrease. As a result of this, the real value of X will fall, right? So I remind you that when we use AD equation, right, C plus I plus G plus X minus M, the components of AD are real values, right? If you don't remember this, recall the horizontal axis of the ADAS diagram. The horizontal axis is R and Y, where the R stands for real national income. So all the components are real. What's the significance of this? The significance of this is that all the values that we're calculating here are using base year prices. So the current price of exports in terms of foreign currency has fallen, or rather has increased. The current quantity of exports are falling. When calculating real value of X, we are using the falling quantity today multiplied by the base year prices of yesterday. So this means that the real value will fall. Hence, the important implication here is that the value of PEDX is not necessary to draw a conclusion as to to draw a conclusion that X is falling. We do not have to assume anything about the value of PEDX. We only need the value of PEDX to determine the extent or the magnitude of the decrease in X. Right? Regardless of whether PDX is greater than 1 or less than 1, the real value of X should be false. There's something to take note of that is important. All right. There is a second mechanism in which appreciation affects aggregate demand. The other mechanism is how the price of imports will become more expensive. The price of imports will become cheaper in terms of Singapore dollars. So when Sing dollar appreciates, everything that we buy from other countries, be it televisions or refrigerators or washing machines, right, are cheaper in Sing dollar terms. As a result, right, local households are going to respond to these now cheaper imports by switching away from domestically produced goods to imported versions of these goods. So this will lead to an autonomous decrease in locally produced goods or autonomous CD falls, which also contribute to AD falling. All right. This second link, right, is a little less important for a country like Singapore because for many of the goods that Singaporeans import from other countries, there really isn't that many domestically produced alternatives. Like, for example, we don't really have alternatives for televisions and refrigerators and washing machines or cars, for example, right? So when most of the things that we import, there aren't a lot of import substitutes domestically anyway. So this second linkage between appreciation and AD isn't really particularly large. All right, so with that, then let's move on to the next slide. Now, when the Sing dollar appreciates, right? Oops, sorry. When the Sing dollar appreciates, the hang on, I need to, it's a little bit off. Okay, when the Sing dollar appreciates, the AD will fall as explained earlier. When AD falls, right, this will cause a fall in the G shown in the diagram and the fall in the R and Y. Now, a fall in GPL is normally described as deflation in the economy. However, in this instance, right, particularly if you guys are doing this for the exam, do not call this deflation because we are introducing appreciation as a policy action. The government is using appreciation of the Sing dollar to deal with high inflation. So you're going to presume that there was high inflation. So although graphically we're drawing a fall in GPL, we describe the situation as a decrease in the rate of inflation instead. Right? So please take note, this is really important. Right? So this is not a deflation, this is decrease in real inflation. However, on the horizontal axis, right, you could describe this as a recession, or you can also describe this as a fall in the rate of economic growth, depending on what was your original state of the economy. If initially, right, your economy was experiencing demand pull inflation where AD was rising and causing inflation. RNY is also rising. So when you appreciate the currency that causes AD to fall, then RNY falls back from a initial rising state, right? So perhaps right, RNY might be rising more slowly. But if you are initially facing cost push inflation, so imagine if initially what your economy was facing was cost push inflation, then your GPL is rising while RNY is falling. And then when you introduce a contractionary policy here to appreciate the currency, this lowers back the inflation rate somewhat, but it pushes RNY further. Then this would be more suitably described as a recession rather than a decrease in the rate of inflation. All right. Now, on the AS side, when you appreciate the currency, right, the imported inputs also become cheaper. So let's say you have a 10% appreciation of currency, imported inputs also become 10% cheaper. This will lead to unit cost of production falling and SRAS curve shifting downwards to reflect the lower cost of production. And this lower cost can get passed on back to consumers in terms of lower prices. So as a consequence of this, your AS shift, I'm using green color to indicate here that the AS shift down is going to lead to a further decrease in PPL. Again, recall, we do not describe this as a deflation. We still describe this as a fall in the rate of inflation. Now, based on this, right, you can tell that appreciation of the Sing dollar is a particularly effective policy tool because when you appreciate the currency, it leads to two effects, AD falling, AS also falling. Both AD fall and AS fall are contributing to GPL falling. So you actually have double the effectiveness of this policy where you have AD shift caused by the appreciation causing lower inflation, the AS shift also causes lower inflation. Now, how about the harmful side effect? If you look at the other axis, right, when the AD falls, RNY falls, but when the AS rises, RNY rises. So now you have two opposing effects. Which effect is going to dominate? Well, the resultant effect is that RNY will actually end up rising, or actually RNY will end up falling or rising, sorry. So the decrease in AD will cause a bigger fall in RNY, while the increase in the AS, right, will cause a smaller increase in RNY. Now, why is that the case? Do you need to know this? Yes, you need to know this. You need to be able to explain this during the exam as well. All right, so let's try to explain this logic. Okay, so let's, if you are not clear about why the AD shift is going to be bigger than the AS shift when there is an appreciation of the currency, is that when you appreciate the currency, a 10% appreciation will lead to 10% cheaper goods, right? Let me see if I have this slide below. I don't have that slide here. So let me draw it here. A 10% appreciation will make prices of exports cheaper by 10%. That means foreigners will think that our goods are 10% more expensive than before. So because of this, they will buy fewer units of our good, right, based on a certain level of elasticity of demand for exports. Now, however, right, this 10% appreciation will also make imported inputs, right, cheaper by exactly 10% as well, as I was shown earlier in the previous slide, that this will cause imported inputs to fall by 10%. Now, this will cause unit cost of production to fall, right? Because as inputs become cheaper, unit cost of production will fall less than 10%. Right? Why does unit cost fall by less than 10%? The main reason why unit cost fall by less is because imported inputs, right, cannot possibly account for 100% of all inputs used in the production process of a country. So there will always be local input used. In fact, right, if you recall, I've talked about this either in previous video as well as in class, right, that the Singapore's import content of our exports is 81% based on the United Nations Commission for Trade and Development in 2017. They published the data that shows that on average, right, every dollar of exports that Singapore sells to the rest of the world, on average, 81 cents to that dollar went towards paying for inputs used to produce that export. Right. So because of this the 10% depreciation of the appreciation of the Sing dollar, which lowers imported input prices by 10%, will end up lowering unit cost of producing exports in our country by 8.1%. Right? And if we assume that this entire 8.1% is passed on to the consumers of our exports, right, in terms of prices, so then the Sing dollar price will fall by 8.1%, but the US dollar price or the foreign price of our good will rise by 10%. Then the net effect is that foreigners will perceive goods as more expensive, they will end up buying less, and this is why your RNY will end up falling still. Right? There should be a net decrease in RNY, indicating that we actually produce less exports and sell less exports than before, right? So this is the key idea as to why in Singapore we have, or actually not just in Singapore, for every country for the matter, right? When you appreciate a currency, the AT shift it will be bigger than AS shift. Except that for Singapore, because of the high import content of 81%, right? The green color arrow here, right? This big shift, right, is actually almost nearly as big as the initial fall in the AD. So the resultant decrease, this harmful side effect is relatively more harmful side effect. Now, this makes exchange rate appreciation all the more a good policy for Singapore. So it becomes something that is particularly effective as well as a very small harmful side effect. Right, so coupled with the fact that MAS only appreciates the Sing dollar in a very, very gradual and modest level, right, that minimizes the adverse effect on the bilateral trade of Singapore or the economic growth of Singapore. And if you couple that with some long-term potential growth in the economy due to both technological advancement and improvements in education and skill, right, then perhaps we might not even have to actually suffer a real loss of competitiveness. Right, but essentially, this is how the appreciation of the Sing dollar is used to address the high inflation in the country. So that makes it a really good policy. Now, just to give you a sense of how this is actually played out in Singapore, right? If you look at the last 25 years of data in Singapore, I managed to get the data from MAS website to look at the past 25 years of policy action. So starting from 2001, we had maintained a gradual appreciation. And then around 2001 July, due to some economic turbulence that later on eventually was overtaken by events like the 9/11 terrorist attack on New York, followed by SARS, right? So there was a series of events that kept economic activity relatively weak. And that is when MAS switched from a gradual appreciation to a zero appreciation stance. So a zero appreciation stance is not to be confused with depreciation. Please be careful about this. So I think many of my students wrongly present zero appreciation as if it's a depreciation. The MAS doesn't do depreciation. What they do is appreciate when there's inflation, depreciate when there isn't inflation, or when inflation is not particularly high and growth doesn't look too rosy. Right. So other than that, you can see that once we go back to 2004, when the economy goes back on track, then inflation starts coming back. The MAS started to gradually appreciate the Singapore dollar again. So it became a gradual appreciation all the way to 07, where slightly elevated inflation rate even saw the MAS steepen gradual appreciation in October 2007. Right. But then eventually we got hit by the global financial crisis of 08 and 09. This is where the MAS switched to zero appreciation again. Right. But post-crisis, 2010, inflation rate went up again to a very high level. So MAS quickly appreciated the Sing dollar, even steepened the gradual appreciation by October 2010, and pretty much maintained gradual appreciation all the way through to about 2016, where we switched to a zero appreciation again. This time, the zero appreciation was not caused by some economic downturn or recession, but actually this was caused by falling oil prices. This is thanks to the lifting of the ban on fracking under the Obama administration, right, that led to USA becoming one of the largest oil producer and exporter. That led to world oil prices tumbling, and thereafter the price war between US and OPEC that led to oil prices falling to like less than $30 a barrel. So during this time, all the entire world enjoyed cheap oil, right? So this cheap oil meant that unit cost of production fall dramatically around the world, including Singapore, that is a very oil-intensive country. So this led to a deflationary situation. Not much is AD falling, but it's an AS curve shifting to the right, driving prices down. I think the Singapore inflation rate managed to clock a negative 0.1% that year as well. All right, so this is the zero appreciation period for 2017. And then thereafter, we went back to gradual appreciation when the inflation started to pick up again. And then we got hit with COVID, right? And then during COVID, even though in the worst recession, right, Singapore doesn't depreciate, right? But we also switched back to a zero appreciation of the Sing dollar. And then after post-COVID, late 21, post-COVID recovery, the consumption came back. We were very inflation went up rather strongly. A big part of it was due to the pent-up demand. A big part of it was due to the expansionary monetary and fiscal policy used by many governments during COVID, right? Suddenly unleashed. Previously, people were holding the cash, right? Then post-COVID, people were just spending. And then this excess liquidity boosts demand dramatically in the economy and global economy, actually, and high inflation. Ever since we've been maintaining gradual appreciation. So you can see from this table, right, the MAS actually uses only two modes, right, for the exchange rate. We either flip it to a zero appreciation when there is no inflation or low inflation rather, or we flip it to a gradual appreciation when we're facing elevated inflation. The third mode, right, which is flip it to a depreciation. If you look at the last 25 years of MAS policy action, they've not done it, right? They've not done it even once, right, to flip the switch to turn into a depreciation of the Singapore dollar, right? So this suggests that the monetary policy action in Singapore is targeted only at maintaining price stability and not aiming for economic growth or not aiming for some balance of trade or balance of payment objectives. All right, so this is the exchange rate policy of Singapore. Now, before we move before we move on to the Q&A section, right, I want to talk about common misconceptions that students frequently make when talking about exchange rate changes. The first one is whether we need to use PED when explaining how exchange rate affects AD. So the answer is no, you do not need PED when explaining how exchange rate change affects AD in terms of the direction of change. So let's run through this very quickly. If you appreciate the Sing dollar, right, appreciation of Sing dollar will make PX, right, in foreign currency increase, right? So please take note, this is in foreign currency. So I put a note here, PX in SGD hasn't changed, right? But the foreigners respond to your rising price in their currency by buying less. So QX is falling. So what is real X? Now, real X, right, of Singapore is actually not even current X, right? It's base year PX times current year QX. So current year QX is falling. Base year PX is not changing. Firstly, because it's base year. Secondly, because this base year should be measured in SGD anyway. The SGD, even if I don't use real value, even if I use nominal value of X, the PX, even in nominal values, if you use current year PX, right, it should be measured in Sing dollar rather than US dollar, and that should actually be no change as well. So this is why the fact that X, right, nominal or real X, when it's falling because of appreciation, the conclusion that it falls does not depend on whether PEDX is greater than 1 or PEDX is less than 1. Now, having said that though, right, the value of PEDX is still useful because the greater the ceteris paribus, the greater the value of PEDX, the larger is the extent of the fall in X. So it is still relevant to bring in PEDX, but we must be careful to talk about PEDX only for magnitude of decrease in X and not for the fact that X is falling in the first place. Now, similarly, there's another elasticity concept here, right? When you talk about this arrow, right, when the price of imports become cheaper in Sing dollars when we appreciate the Sing dollar, local households are going to switch from produced goods to buying these imported goods. They are substitutes. So the extent to which this effect happens will depend on what we call the XED or cross elasticity of demand, or in some of your schools they call it the CED, which is a symbol for cross elasticity of demand. So don't get too worried if your school calls it CED or XED. It's the same concept, right? So Again, the direction of change, CD falls, does not depend on cross elasticity. The magnitude depends on cross elasticity. So that's the first common misconception I want to address. The second common misconception I want to address is whether FDI is affected by exchange rate changes. Many students have this misconception that FDI flows, right, is affected by exchange rate change. It is not, right? FDI flows is affected by expectations of future exchange rate changes. For instance, if let's say today Sing dollar appreciated and market forms an expectation that the Sing dollar will depreciate back in the near future. That means today's appreciation is seen as a unexpectedly strong appreciation, it should come back down in the future. That was the expectation that was formed. Then with the expectation of future currency exchange rate falling, then investments right today would not be very worthwhile because they any FDI inflow into Singapore, right? If they can wait, they would rather wait for the eventual depreciation that is expected because it will be cheaper then to invest in Singapore. Now, if, however, right, the appreciation today is perceived to be a sign that Sing dollar will continue appreciating, then the signal that it will send to the market is that I better invest now rather than later because the later I wait to invest in Singapore, the more expensive it becomes. So whether FDI flow is affected by exchange rate change, right? It depends crucially on whether the exchange rate change altered the expectation of future exchange rate and how it altered the exchange rate. Now, if the MA has always been adopting a gradual appreciation of the Sing dollar, this gradual bringing stance, right, has already formed the impression that Sing dollar over time will just continue to get stronger. That itself is a pre-existing expectation. Then any changes in exchange rate, temporary rises or go back to zero appreciation should not in and of itself alter expectations, and therefore it should not have an effect on the FDI flows at all. So normally, if this was an essay or case study question, we do not bring up the FDI changes as a result of MAS's exchange rate policy action. All right, so this is important to take note as a common misconception. Third common misconception, whether the LRAS curve shifts. Now, many have this idea that the LRAS curve, right, is something that measures the productive capacity of the economy, which is right? And what causes the LRAS to change is your QQT factors, your quantity of resources, quality of resources, and the level of technology. So does exchange rate change affects QQT? There's a common misconception here that thinks that if Sing dollar appreciates, it is now cheaper to import factors of production. Therefore, we can import more, then we have more FOPs, and as a result, the LRAS shift to the right. Now, that logic is incorrect because if you think about what the appreciation is doing, right? What the appreciation is doing is just basically causing it to be cheaper to import factors of production. The appreciation did not in any way make it more possible to import resources. There was no restriction to importing of foreign factor inputs that is now lifted as a result of the appreciation. So basically, appreciation or depreciation, right, doesn't change how much we can import, but it does change the cost at which we are doing so. So it causes the up or downward movement along the LRAS curve, which essentially basically is saying that there's a shift in the SRAS curve, right? So this is the SRAS curve shifting down when you appreciate the currency. So note where LRAS shift does not affect the exchange rate changes does not affect the LRAS curve. All right, then I'm going down to my last misconception already. If you've got questions to ask, get ready to type in and ask now. Okay, so the last misconception here that a lot of students commonly make is whether appreciation of the Sing dollar will improve the balance of trade of a country. The answer is no, right? When you appreciate the Sing dollar, so when the exchange rate of the Sing dollar increase, for example, assuming Marshall-Lerner condition holds, your BOT has to worsen, right? So your BOT has to worsen rather than improve. So some students have this common misconception is that when exchange rate appreciates, I have greater price stability, right? Greater price stability, and they interpret greater price stability in terms of lower inflation. Now, when you have lower inflation, particularly lower than other countries, right, then that causes an improvement in BOT. So the misconception stems from students thinking that greater price stability or lower relative inflation improve balance of trade. Is this correct? Well, this is correct, right? There's absolutely nothing wrong with this part of the argument. But then students start to recognize that when I appreciate my currency, it leads to lower inflation, right? There is again nothing wrong with this logic as well. So when you have higher, stronger currency, you have lower rate of inflation. So then if A leads to B, right? Let's call these variables A, right? If A leads to B, and that B leads to C, then it follows that A leads to C, right? Well, that would be correct, except we have to remember that there's another link that we didn't consider. A itself affects C, right? As we know, this effect is true as well. Will worsen C as well. So when exchange rate appreciate, balance of trade worsens. Right. So the net effect of this, right, based on economic theory, based on a publication by MAS, which you can find on their website, as well as based on Cambridge examiners past previous comments in past year exams, right, is that when you appreciate the Sing dollar, you cannot argue that ceteris paribus it improves the balance of trade. That would never be accepted in the A level exams. So please be careful not to make this mistake. All right, so then that well, that's my slide actually just in time. I'm 1 minute late. So then that is the exchange rate policy in Singapore. So to quickly summarize, what are the few key ideas? So in Singapore, exchange rate policy is used to achieve two things. Number one, we want to achieve what is called price exchange rate stability. So we want Sing dollar to be as stable as possible in order to minimize exchange rate risk for import and export related businesses, which is a big deal for Singapore being a very small open economy where total trade is about 300% of GDP. Um, Second purpose is we want to use the Sing dollar as a monetary policy tool to appreciate it during periods of higher inflation, and of course to turn it off, right? Don't appreciate it when we don't need it, right? So this is the key purpose of Singapore's two key purposes of Singapore's exchange rate policy. So how we do this is we use the appreciation to lower AD as well as increase AS to bring prices down. So, but because of Singapore's high import content, the AS shift is smaller than AD shift by only a relatively small extent. So the negative harmful side effect of the appreciation of the Sing dollar in terms of hurting RMY is relatively small. So that makes the exchange rate policy an especially good policy for Singapore. All right, so then that brings us to the end of the session that I wanted to cover. Is there any uh, questions that anybody will have? If anybody got a question, feel free to ask. I'll wait about a minute. If not, then I will end the stream. Okay, so we have a question. Give me a moment. How to explain the link from appreciation to BOT? Okay, give me a moment. Let's see if I can find some space for this. Okay, so how to explain the link from appreciation to BOT? So when you appreciate your currency, so okay, first note that BOT is nominal X minus nominal M. I want to emphasize the nominal part of the X and M is because we are using current year prices rather than base year price. So appreciation will cause your PX, right, in, let's say, USD, for example, to increase. So note PX in SGD hasn't changed. So when your PX rises, your QX falls, your nominal X today, which is current PX in SGD times current QX. So what's the effect? QX is falling, PX is no change. Remember, this is SGD PX no change. Then QX on the nominal X falls, right? So X decreases. So we know this falls for sure. So when you appreciate your currency, then what happens to your M? So when you appreciate a currency, price of imports in SGD falls. As a result, quantity of import falls. Rises, sorry. So QM rises. So what happens to nominal M? Nominal M, which is PM. Oops, sorry. Nominal M, which is PM times QM. So what's happening to PM? What's happening to QM? PM is falling while QM is rising. So M is actually indeterminate. So now if we were to add in an assumption, and say suppose if PEPM is greater than 1, then the rise in QM will be more than proportional than fall in QM, then M falls, right? So if, sorry, my mistake, M rises, not M falls. So if QM rises more than proportionate to PM, then M rises. So if M rises, QM X falls, then BOT worsens. So this would be the way to explain how the appreciation will worsen the balance of trade of country. Now, of course, my entire answer, right, hinges on one key assumption, which is assuming price elasticity of demand for imports is greater than 1. That may not be the case, especially for a country like Singapore. Then in this case, if it doesn't work, then you have to invoke the Marshall-Lerner condition to help explain this, to help explain why the nominal M actually also falls, but why the fall in nominal will be greater than the fall in X. So as a reason, will be smaller than the fall in X. So therefore, the BOT wasn't still. Okay, but that one you can go to watch my other video about Marshall-Lerner condition. Okay, so I have another question here. Oh, sorry. Before that, I wasn't able to show this because my video was blocking. Give me a moment. Let me remove all this. Okay. So earlier, I think my banners and the comment was blocking. So let me recap this part. So when you appreciate the Sing dollar, the imports become more cheaper. Singaporeans buy more imports, so QM rises. So nominal M, whether it rises or fall depends on the extent to which the QM rises is able to offset the fall in PM. So earlier we said if we assume PEPM is greater than 1, then the rise in QM is more than proportional than the fall in PM, hence M rises. So when M rises and X falls, then X minus M will surely worsen. This is how you explain how the appreciation will actually lead to a worsening of the balance of trade. Okay, sorry, I just noticed it was blocking. Okay, so next I have a second comment here. No, not this comments. Okay, Josh is asking about the last misconception. So essentially, the direct effect of exchange rate dominates the indirect effect on balance of trade. Yes, definitely. The direct effect dominates the indirect effect of exchange rate. At least this is what, according to the findings of MAS in the publication that they published quite a number of years back, and also according to what Cambridge examiners viewpoint is. So your appreciation, assuming your Marshall Lerner condition holds, will worsen your BOT. While that appreciation leads to an improvement in the price stability in the longer term, which can in turn leads to an improvement in the BOT, that should not offset the effect. Okay, thanks for the questions, Josh and FR, whoever that is. Do I have any other questions? Okay, today we don't have that many people online. I guess because this one I've gone through in class. So I've decided to do this also more because of some of you like came back to me and say, I forgot some of the details. Can you do this as a video so I can review it? So this is me doing it as a video for you to review. All right, so if you don't have any questions, then we will end the stream today. And please feel free to text me for questions, or feel free to add questions into the comments, type into the comments, and I will respond to your questions. Okay, dokes. Thank you very much. Have a good evening, everyone.